Okay, so this week we're going to talk about Chapter 8, Inventory. Let me see if I can get the... Okay, there you go. Inventory is extremely important when it comes to certain types of business. Now, inventory isn't that important for some businesses, right? Like take Southwest Airlines, or they just don't have inventory. Is not part of their business. Their business is moving people around the country in an airplane, right? Um, Same with Blue Cross Blue Shield. That's assumption of risk as far as insurance is concerned. Inventory is not something you'd want to analyze for those companies. Uh, they don't have an impact on it. But for other companies, Coca-Cola, for example, manufacturer, Walmart, another big company, but that's a retailer, or wholesale companies. Inventory is their life. It is what they do. Um, Manufacturer of Coca-Cola needs inventory to do that. Uh, Walmart sells inventory that they buy and they sell at a higher price. You have to analyze those, and you have to understand the implications that we have with those companies on their financial statements, on their balance sheet. You can see in a wholesaler or retailer like Walmart, the inventory, there's just one inventory. But for a manufacturer like Sherwin-Williams, you see there's three different inventories. There's finished goods, work in process, and raw materials. All three of those are different inventories that you have. This is paint that's completed. This is paint that they were working on as of December 31st, 2011. And the raw material would be the stuff that they make the paint out of and how much they had in 2011. The perpetual system is based on following inventory and calculation of cost of goods sold at the time of the sale. Okay, so inventory is maintained at Walmart, for example, uh, you know, on a perpetual basis. As of the time of the sale, this information is recorded. I don't know, I'm assuming Walmart has a similar system to that. Um, so that's what perpetual system means. It means that at the time of the sale, cost of goods sold is calculated. Inventory numbers are updated, right? They may not know exactly what specific football Walmart sold, but they do know that they sold one football and they only have 8 left in the store, for example. And more importantly for accounting, they take care of the cost of goods sold at the time of the sale. That's what perpetual system has to do with for accounting, is taking care of cost of goods sold at the time of the sale. Whereas with periodic system, you have to do an inventory count and figure out how much ending inventory you have periodically. So from time to time, they calculate this. And by doing this, they can use this formula here to calculate the cost of goods sold. Instead of doing it at the time of the sale, it's done periodically. Now that doesn't mean that there's no inventory counts. The system is accurate from time to time, but it has to do with when you're recording, maintaining the inventory records and recording the cost of goods sold. Here it's done at the end of the period, maybe at the end of the month, at the end of the quarter, at the end of the year even, is when we do this calculation. This ending inventory number then is going to be a challenge for us, right? Because we know that things have been bought and they have been in inventory for us, and we don't need to know which of those things were sold. And we don't know. You just don't. Even Walmart doesn't know exactly if they bought 10 batches of footballs for different prices. They don't know which football they sold. They only know they sold a football. So to do that, you're going to need to do LIFO, FIFO, or cost of goods sold. We'll get to that in a second. These general rules are important, and I'll go over that with one of the problems that we work. But for now, just keep in mind this is important to knowing what inventory needs to be included, right? Not just the stuff that's in the warehouse, but is it FOB shipping point? Is it FOB destination? Or is it a consignment good? Again, I'll talk about that in one of the other problems. For LIFO and FIFO, remember, these are assumptions that we have. First in, first out, last in, first out, average cost. Let's see, the first one we have is, oh, here's the information. So we have the call mark, it sounds like Walmart. We have $43,900 worth of goods available for sale. What we had, and what we at the beginning plus what we purchased. The average method says all we're going to do is we're going to take all of the stuff that we have available and then divide that number by the total cost. So 43,900 divided by 10,000 units, and we get an average. And we say, okay, our ending inventory was 6,000. Those 6,000 units go at an average of 439. Cost of goods sold is based on the average. If the first in, first out, then we're going to pretend that the stuff that we had first was the first stuff sold. In that case, what was sold comes first from the beginning inventory, and then any additional ones that we need comes from subsequent purchases. Since so we see here, it's kind of this format's a little bit confusing. You might see a better format in the book or in another area, but we see that we end up with the 6,000 units at the end that are based on the cost of goods sold were based on the first units out. Cost of the goods sold first out. First in was the first sold. Cost of goods sold first. Last in, first out goes the other way. In other words, the stuff that we had last, that we purchased last, are what we're going to consider sold first. Kind of backwards, right? So what we're going to do is we have our sale of 4,000, and we just say, well, what was sold? Where did that come from? Well, it was sold. We're going to take the sold stuff from the most recent batch, which was in this case, the most recent batch was 6,000. Other problems we'll go through specifically. That was just an introduction to what these things mean.